Before we get to today's chat, just a quick disclaimer. This content is for educational and informational purposes only, and by no means financial advice. All investors are encouraged to do their own due diligence and are responsible for their own investment decisions. Welcome back to yet another go-round worth of masters of the market. This week, I cannot be more excited to have on with me Darren from Blossom, here to share his story, where he's at with his portfolio, income investing. He is just a powerhouse in this space. So Darren, welcome to Masters of the Market. I want to go ahead and pass you the first question here, which is, what's your story and how exactly did you get to where you are today?
Yeah, right on. Thanks, Ari. I really appreciate you inviting me on. What's my story? I'm nobody special. And unfortunately, early in my life, I didn't do a lot of investing. So when I got to the age of 50, so right now I'm 52, my wife, her dad managed her investments and stuff like that. And I didn't have anything to do with it. And then when he passed away, of course, which was very sad and tragic, I had to then take a look at the finances. Now, I have a pension and my wife doesn't. So in my eyes, I thought, okay, this will be fine with my pension. Then we had kids, and I'm sure a lot of people can appreciate that sort of when I bring that up. It's you have to look at that legacy thing down the road. When you retire, it's not just your money anymore. That money will eventually probably be your kids. So I was like, okay, well, what do we do now? And I looked at how much she had and I was like, ooh, okay, probably need to work on this a little bit. I don't know anything. I literally don't know a thing. I know what in Canada, what an RRSP is. I know what a TFSA is. For those people that are from my age, you will understand when I say, you used to go to the bank. You take your bank book, you go talk to the bank teller. You'd be like, I'm putting my money in the bank and we're going to put it in a savings account and we're going to make 0.5% interest. That's the way I grew up. That's literally how I thought investing was. And then this RRSP thing, well, I guess you put some money in there and it grows on its own. No, it doesn't. You have to actually do some stuff. So that led to going to the internet. And obviously in 2023, YouTube was the best place to start. And after sort of, typing in some keywords, ultimately from that, I realized, okay, I have a lot of learning to do. And immediately realized, well, wait a minute, if I made it to this age, I must not be the only person. And although there's lots of channels and content and things like that, I thought, I think I'm a bit unique. Actually, at the time, I didn't even really, that didn't twig to me until Gary Gill interviewed me. And he was like, your target audience isn't young people. Because that's what I thought. I thought, oh, how about I make this content so that people can actually, learn from it and don't make the same mistakes. That's kind of where I started. But Gary's like, no, there are people your age that need this. I was like, oh, interesting. So that's kind of where the Crazy Canuck Investor started, the YouTube channel that I have now. And, I'll be honest, part of it is I enjoy the content creation. It's a challenge to be in front of camera and talk to someone, about something very little about. I actually said in my last video that I don't think I'm a beginner anymore. I think I'm more like a novice. And I think a lot of that is thanks to Blossom. And that's not really a plug. It's going to sound like a plug when you guys are listening to this, but I kind of frame it like investing's a puzzle or like a new job, and you have to bring those pieces of the puzzle together. And for me, that's what Blossom did for me. It's like, well, where can I put all this together and listen to people's perspectives and stuff like that? So right away, I discovered Blossom, and I've been on it ever since 2023. And fast forward to today, my channel is growing at a decent pace. And now I'm engaging with people like yourself to be able to have these conversations.
Well, Darren, I have to say, first and foremost, I'm happy you're a part of the Blossom community because like I opened up with, you're a powerhouse in the income investing space and just now in the investing space. I like how you shared you're no longer a beginner. I think at some point or another, we're all like, it's been a couple of years. But something in your story, Darren, you shared, you started at 50. And the first question I want to ask you is, was there a lot of fear around starting at 50? Do you still have that fear, or is that kind of tapered away in knowing that you still have time?
Yeah, that's a great question, Ari. Yeah, of course. It was like, well, you want me to open an account and you want me to start, and in my case, so if I was 20, and some, like a lot of us creators will say like, oh, you should start off with $100 a month or something simple. I wasn't starting with $100 a month. You can tell from my journey, I started with $220,000. And to most people, it's like, whoa. In fact, I just got a message, a DM from somebody that, that's sort of what their position is. They have a bunch of money and they wanted to sort of figure out what they should do with it. That's pretty intimidating. But what I learned is it doesn't really matter. Like, a lot of people say, well, you should dollar cost average, or, the lump sum approach is actually better. Well, what I found, and this is going to hopefully resonate with a lot of people, it doesn't matter what you think at the time when you start investing. You're going to be nervous like I was. You're not going to know what you're doing. You can't. Like, there's no course, like nobody sat me down, although, again, this can sound like a plug, but that's what I love about Blossom is there is a way to learn within Blossom from the learn section. That's one of the things that really resonates with me is listening to other people, reading books and stuff like that doesn't give you the foundation. When I took my first career as a paramedic, I went to school and I learned the foundations of all that. I didn't know how to give all the medications and stuff like that when I first started. It took 2 years to go through that program and it built on itself. Well, it's the same thing with investing. So when I started, I was like, what do I do with this money? I'm going to dip my toes in the water. I'm going to see how does this work? And then after the first few times I did it, and back then in 2023, the broker that I was using was Toronto Dominion Bank here in Canada, which is in the US as well. And they were charging $10 a trade, but I didn't know anything else. I didn't even know about other brokers and stuff. I was like, $10? Ooh, that's a lot of money. And then of course, eventually that was like, well, what do I do about that? More research, find places like Wealthsimple or Questrade and so on and so forth. What's the best option? Oh, wait a minute. You want to manage your fees. Fees are incredibly important as well. So yeah, it was incredibly intimidating. And to a certain extent, some of it will always be there. When you're learning something new, you're going to have a little bit of hesitation, I guess, but the fear isn't there. Just the fact that I can sit down and talk with people is a big deal. The first interview that I did with Mo from Momentum Finance on his channel, I was pretty intimidated about that, and I've been doing this for a couple of years, but now I'm going to be asked questions about this stuff. And I think for a lot of people that are in this space, I guess if you want to call us influencers, there's a Canadian dividend investor here in Canada. He was one of the guys I started watching. He's very upfront. He just says, look, I'm putting these out because it helps motivate me. Keep doing what I'm doing. The more I learn, the more I post, then it makes it easier for me to, sort of reinforce what I'm doing.
I love that. And it's something we were also talking about, before I hit record here, which is just like the amount of inspiration that comes from just having these conversations between me and you, and other people get to listen and chime in the comments. That does beg the question, though, when it comes to even talking to younger investors, because your story is that you started at 50. So there's a lot that's probably there that you wish you had done earlier. What would be those tips and tricks that you would give to the younger investors that also might still be applicable, though, to older investors who are just starting?
Yeah, I think the foundations of investing are similar no matter the age, right? It's about, the first big steps, and I talk about them in some of my videos because I think they're almost more important than the investing part, which is if you have debt, you got to get rid of that stuff because there's no point investing. You got to get rid of the credit card debt. And I did that when I was in my, graduated from high school. And like I said, I was a paramedic when I first started. I had to volunteer my time to get going on that. So I spent money on school and this and that. And guess what? I bought a $30,000 motorcycle. I just want you guys to pause for 1 second and think about that. I talk about investing small amounts of money. So if I was to make some suggestions to people, it'd be like, you're not going to be making very much money, especially if you're going to university or college, whether you're in the States or Canada or whatever. Pick a small amount of whatever your income looks like and set that aside. It can be $5, $10. Just build on that foundation. That's a foundational piece. So get rid of that debt. Don't do silly things like buying a motorcycle that you don't really need. The one I bought, I literally walked in the store. It was brand new. And it was because I was working with someone that had one. And I thought, oh, this is cool. And I just said, here, sign on the dotted line. Borrowing money at incredibly high interest rates. Why? Why did I do all that stuff? If I had known a lot of the stuff from, like you say, are these conversations that I'm having here, it would be like head scratching. When people share their stories about where they were and where they've come to, that's power. That's powerful. You mean to say that you dug yourself out of debt? I did that. And then eventually, we had a home and I realized like, what's the difference between good and bad debt? All these little things. So all those foundational pieces I think are really important for new people looking at it. You're going to be intimidated, but you got to start somewhere. So like the one video I did was talking about, I wish I had done $100 a month, something simple. The word consistency is so important. And again, like if you look at what you're going to invest in, even consistency may apply there in your strategy, but that might sort of change over time. But you have to be consistent from the start. I like to use the 20, 30, 50% rule. So 20% goes to investing, 30% goes to the sort of non-essential savings, if you will. So that might mean going on trips of that. And then 50% goes to pay for all your bills and stuff. I know that sounds silly. Some people are probably scratching their head going, how come you didn't know that? I didn't grow up in a financial, blessed home where people knew stuff like that. My parents, they believed in Canada in GICs, which would be similar to bonds, like we put our money there and it's safe. So yeah, foundationally, I think all those simple things, they need to exist no matter what age you're at. And that's where I started. And now I feel like I have a good foundation to decide how much of the income. And then, how much more can you add to that over time? Because it's that piece that compounding really starts to work. And a lot of people, I remember when I listened to compounding, I'm like, that sounds great, but like, when do you see it? Well, it's a bit of a psychological game. You have to believe in the concept. The calculator will tell you it works, but the more you add over time, the more it will work for you. And I'm seeing that right now, in my own portfolio. So
I love that. You got to give it time, and time is what I feel like a lot of people think they don't have. And we wrestle with this idea of instantaneous gratification or instant gratification and getting things right now. And it happened to you. It happened with that motorcycle. So how would you go about sharing with people? Because I firmly believe that this is a building block to personal finance and investing, is training yourself on delayed gratification. So Darren, how would you help train someone, or what thoughts would you share around that? Because that's such a important building block to put into place before anything else.
Yeah, no, you're absolutely right. Actually, it's funny you mentioned that because I'm working on some new content, and one of the pieces of that is that psychological piece and that gratification piece. Because let's face it, I started with $220,000. I would love to see that money be $1 million tomorrow, but that's not going to happen. What is going to happen is that foundation that I've built will slowly grow over time, and every time, okay, folks. So this morning, I sort of automate my investments, but I have certain days of the week when I get paid and things like that I do it. And it's funny because I was thinking about talking about this with you. So today is the day that I put money into my tax-free savings account here in Canada, as I'm trying to max that out. That's why I started my channel. I was excited this morning. So that gratification, yes, I know the money's going to grow for me, but it's not like scratching a lotto ticket today and I win tomorrow. What it means, though, is I got to put money in the market today. And it didn't really matter. Well, it does matter what I put it in. But the point being that gratification, it needs to be delayed in some ways and find other ways to do it. So for me, I think that's why content creation and conversations like this are so healthy and important, because we're discussing this before we started recording, is I get gratification from doing this. If one person listens to this and they go, well, wait a minute, that guy started really late. He seems to be pretty happy about all this. Maybe it's not that important to have that, gratification like right now. And there are a lot of conversations about that point towards certain investing types that say, well, that gratification's coming right now. But no, find ways to make money fun, if that makes any sense, Ari. You have to find a way to, I call it having a relationship with money. It took me a while to kind of understand that. What does that look like? Well, what it looks like is, I'm going to dedicate certain funds to do certain things and find something good about that. So if I'm setting money aside because I want to go to Mexico, then the gratification will come, as I put the money aside. And then when I get there, if that makes any sense.
Oh, 100%. It sounds like you have gamified investing, and I think a lot more of us need to gamify investing. So what are some of the tips and tricks you can give us there? How have you gamified it so you can have fun this whole process, it's all about delayed gratification. A lot of people see that delayed gratification as one thing, which is sacrifice. But when you gamify it, we get something else, which is now gratification, what you're talking about. Are there other ways that you have gamified this whole system?
Yeah, that's actually a really great analogy. I've never really thought of it that way, but in a sense, that's totally what it is. If I could show you guys that are watching, I'm in my bedroom here, and I was telling Ari before we started shooting that over time of my content creation to share this journey, because that's what I'm doing. I'm not a financial advisor. That's not what this is about. I want to share my journey because I feel like it motivates people. But if I was to show you all the things that I do, like kids leaving this morning, setting this room up to do this with Ari, that's the gamification piece. My wife was actually, so the laptop that I'm shooting on right now is technically hers. She hates it when I use it, but she said, I see the value and how important this stuff is to you. And so I guess that's that gamification piece. It's funny, like the investing part of it is really boring, to be honest. And what I mean by that, folks, is not that investing is boring as a whole, but the strategy that I employ as far as investing, at least right now, it's actually pretty boring. And what I've learned from a lot of people that sort of been doing this for a long time is that's pretty normal. But everything that builds up to it is not boring. So on Blossom, I open myself up to all kinds of comments when I'm a creator or posting, because you'll get both positive and negative and feedback and stuff like that. And oftentimes you'll get a suggestion. Oh, hey, what about this app or for tracking your dividends or whatever? That's the part that's powerful. It's like, oh, cool, something else to check out. Now, it might not work out to be something that I may or may not use, but that's what I love. So, when I look at that gamification thing, it's like, I remember when I first started my first career, and I really enjoyed going to school, building the skill set. And then at some point, after about 10 years of doing, like I said, I was an advanced life support paramedic in Canada. I was like, this is kind of boring now. Where's the challenge? But with this stuff, there's always something new. I was watching a video last night about HHIS because it's having some changes in the market. And I was like, oh, this is fascinating. This is someone's perspective on this, because I don't have enough greater knowledge. Like, I don't have the letters behind my name and stuff like that. So to me, that's the gamification. Oh, something else to learn.
So I want to talk about, I guess at this point, some strategy. And I'm sure your strategy, Darren, has changed over time. But because investing is intimidating for a lot of folks, they think they need the perfect strategy to start. Can you talk about how you started, and then how over time your strategy has changed, adapted, and remolded to where you are today?
Yeah, absolutely. So, and I think that's important, but I already sort of alluded to the beginning. You're going to, if you want to use the word mistakes, sure, we could probably dummy that down to something else, but it's not going to be an easy road. You're not going to make all the right decisions. And let's face it, when you you think about people like Warren Buffett or other great investors in that space, they didn't make all good decisions either. And it's okay to, dip your toes into something and go, oh, that wasn't, a good choice. So for me, like I said, I did a lot of YouTube research. I also read a lot. I'm not a big reader. I'm more of a visual person, but I did read. I listen to a lot of audiobooks as well. I'm a cheater when it comes to reading, but that information piece drove, what do I do? Like, how do I do this? And one thing you'll hear a lot of us say in the creation space is don't do what we do. And that's really hard. There's no doubt about it. If I listen to you, Ari, and you were to talk about your portfolio, I might go, that sounds kind of interesting. Maybe I should try that. That's going to happen. It is definitely going to happen. The key, though, is to realize that Ari didn't make that decision today. He had some research that eventually went into it. So if you start with a position, and it doesn't matter what it is, whether it's an ETF or a single stock or covered call or whatever it is, if you don't ask yourself this one question, what is this all about? I know I put my money in it because someone else thought it was a good idea. You might have you need to take that next step. You need to do a little bit of reading. Go to the website of, whatever company is offering this product and do some reading. Again, that's that gamification piece. This is interesting. What can I learn from reading this? Analyzing the information. And so I think that's really important when it comes to setting up your portfolio. So I did all that stuff, and the person that I found provided me with, for whatever reason, it was Ben Felix. He had this model portfolio that I stumbled across. And for those of you that don't know Ben Felix, he He does work for PWO Capital here in Canada, which is a advisory company, investment company. But they also have a podcast called The Rational Reminder, and it's very evidence based. And so for me, being a very concrete learner, I found that interesting. And I'll admit, a lot of times I'm listening to the content, I feel like I'm absolutely drowning. But every time I listen to something new, it could be that podcast or someone else's, I learn something new, and then I apply that to my portfolio. So, for instance, if someone said to me, like, you have some overlap in your portfolio, why do I have overlap? What does overlap mean? How can I deal with that overlap? That is how I started creating it. So, it's all ETF based, is kind of where I started, but I did do the shotgun approach. So, I kind of went across the board. I took some dividend stocks, like there's some energy companies in Canada that I was able to, oh, that's got a great dividend. That sounds like a good idea. Let's try that. We'll try this ETF. Oh, what's this, high yielding fund all about? Let's try some of that. I did that. I tried it all, like sort of spray it across and catch everything. But the more that I learned about what worked for me, and it's up here too, it's not just what you learn, then I was able to establish kind of a better focus on what I wanted my portfolio to look like. I'm listening to an audiobook on dividend investing right now. It's very fascinating, and I'm finding a lot of parallels in the different strategies. And there's some things I want to draw out of that audiobook to sort of look at my own strategy and see how they apply. So that's kind of how I set it up. And then it is essentially broad-based ETFs for the most part. And I do have some all-in-ones in there.
So I like how you mentioned, again, for everyone who's tuning in, or clicked maybe halfway through this video or 20 minutes in here, Darren's on Blossom. You can connect with him on Blossom. Highly recommend it. Link down there in the description and pinned comment to do exactly that. But you mentioned on Blossom that you get a lot of comments and even DMs with people either suggesting something, their own opinion, sometimes for better or worse, invited or not. But it always strikes the chords of curiosity, which same thing for me. I think that's the most important thing as an investor, is to always remain curious and to be an investigator, so to speak, because someone's going to give you, even if it's a very strong opinion, the opportunity to have you change your perspective. So when you go about responding to people or engaging in these conversations, I'm sure you've also realized that there's like this crazy feud between income and dividend investors and growth investors. What's your 2 cents on that? Does it matter? Like, how should someone go about deciding whether they should be growth or income or some balance and in between?
Yeah, that's a very in-depth question for sure. And it doesn't have an easy answer. And I'm still learning. Again, gamifying, I want to learn more. I want to truly understand. But I want to listen to everybody's perspective. And I think understanding the strategy, understanding the psychology behind investing, that's equally important. Because, we mentioned about that gratification piece. That's the part that people struggle with, and also your risk tolerance too. I didn't mention that earlier, maybe because it is important, but people don't even realize what that means. What is risk tolerance? And the example that I like to use for risk tolerance and whatnot is back when, at the beginning of the year, when Trump got in, the markets took a pretty big beating, and if you're don't understand your risk tolerance, you look at your portfolio and you're like, where did $30,000 go? That's pretty rough. So there's a lot of, like I said, like that psychology piece in that income space, I think may drive some people to make certain decisions. I think I mentioned to you off camera that I'm working on some stuff. I did an interview with Better Call. I won't call it interview. It's a podcast. We're kind of like this, where we're just talking about the growth versus income. We're going to do a bit more of it. And it's going to be able to allow me to learn more by asking more and then engaging with Paul about these subjects to understand from his perspective why he's doing it his way and how that might apply to me. So, yeah, I wish there was an easy answer to that one. But I think if you can invest your money in whatever it is you want to invest your money in, and you can sleep all night and you don't have any bad dreams, I don't think there's anything wrong with that. On the other hand, if you have goals, so that money that you're investing, I assume there's goals. I mean, there is for me. That's how come I started, as I told you. Those goals that you have for your money should then drive that gamification and that learning to make a more informed decision about what strategy may work best for you. Like I said, this dividend investing strategy, it's actually kind of interesting because I see a lot of parallels between the growth and the income world, kind of like tying things together in some ways. Sort of interesting. So, yeah, I wish I had a really great answer. Come back to me on that one after I've done a few more interviews with or podcasts with Paul. But yes, that is a very hot subject. My only piece of advice to people would be just take the time to learn a little bit every day so that you can understand what that strategy does or what the other strategies do for you and your money.
I'm a fan of what you shared in that points on the board are points on the board. Like if you're not, Warren Buffett's number one rule of investing is don't lose money. And that's followed by rule number 2, which is just follow rule number 1, right? So
Yeah.
as long as you're not losing money, I think you're on the right track. The question though, for me that would come about is, okay, well, if I give you 2 avatars, these are 2 very different types of investors, and factoring in their different factors as investors, like their level of risk tolerance and their timelines. But that investor that's in his or her early 20s, should they be investing like the investor who's in their elder years?
No, I don't think so. I think that's definitely one of my big takeaways. But that's hard to convince people because of that instant gratification piece. When Jared, I think that's his name on Blossom, he started his own channel. And kudos to him. He hasn't posted lately, but he shares an interesting story. He's a student who's in post-secondary, kind of what I wish I had done. And he's realized, hey, this is a thing. And he got lots of attention when he posted his stuff. But he was caught in that income question. He's like, oh, I'm generating income and I'm feeding the beast, is probably the way I would put it. I don't know that that's the right strategy. I don't know that I would have done it that way. But I also have the advantage of every day learning a little bit more to understand that someone that age probably shouldn't be. But as I said, because of the psychology piece, if that makes you feel better, and I want to hit on one more point, Ari. It resonated with me a lot because I was DMing with somebody about this who's the same age as me. And we were talking about the growth of your money. If you look back before 2023, I had, well, it wasn't quite zero, but it was very little money in the markets, at least not like this that I'm doing now. Well, my money's working better for me now than it was then. So as you said, points on the board is better than none. And so you got to start somewhere. It's like foundational, I think, is really what it comes to. So, my advice if you're young is I don't know that I would be going down that income route. Now, on the other hand, I suppose, is if there was some need for whatever reason in the short term for you to generate some income, then maybe that would apply. But I can't think of too many circumstances where that might be. But each person, they're going to be different. But no, I don't know that I would steer them towards that in the beginning of investing, especially young people.
Well, Darren, there's so many YouTubers, who are out there, and I've been in this space for a bit now, and I will openly share, when I first got started investing, Andre Jick was like, for me, the go-to guy on dividend investing and got me hooked on it. And if I were to sit down with my younger self, I would say, hey, that's a great starting point, but as you keep alluding to, like, keep learning, keep growing, and adapting, because where I'm at now and how I'm investing now is definitely more in line with how I feel an investor at 31 years old should be investing. But I don't think there's enough investors yet across platforms who are in your shoes around 50 who can kind of give more of the ropes or belay the ropes down to younger guys like myself and even younger because of the experience that you have. So I think you raise a lot of interesting points there.
Yeah, I think too, like the last conversation Paul and I have, one of the shorts that I put out is Paul talking about Mo and his XEQT strategy. And by the way, seeing as I'm mentioning it, if his channel is called Better Call Paul, if you guys don't know, he's also on Blossom. But needless to say, he was talking about XEQT and that strategy. And so I told that short out because it's just Paul talking about XEQT. And for all of those that don't know, that's an all-in-one fund. And the only reason that I'm mentioning this specific fund is simply because his content and his strategy is all income-based. But that fits for him at his age. He's the same age as me. But But he also acknowledges in that interview that his kids, who are in their, like we're talking about, in their early 20s, he's encouraging them to invest in a different strategy. So even he acknowledges that while this works for him, it may not work for others. And understanding that strategy is so important. And that's why I'm going to keep coming back to it. Blossom is a great place to do that. And it will challenge you. Like, the one thing I have noticed is like any app, the algorithm really feeds what you search, unfortunately. So you need to be wise to that. I noticed that last night, that because I'm typically reading a lot of that because I'm trying to learn about it. But if you want to learn about other stuff, you have to feed the beast to let it know, like, oh, I want to look about dividends or income or value investing or things of that nature. So sometimes you got to be a little bit careful with that, because your feed will just blow up with stuff that you're searching and stuff. So
I think it's important, when people watch a conversation like this, or they're listening to it, and they have to understand their own investor profile, because sometimes you could see someone's dividend income and be blown away by it. So, for example, on Blossom, again, anybody can go out there on Blossom right now, take a deep dive on Darren's portfolio. Totally recommend it. He's bringing in, according to Blossom, around $25,000 in dividends
annually.
So,
yeah.
Walk us through your entire strategy here, how you're set up, the portfolio. What's in there? Is it comprised of just ETFs? Do you have individual stocks in there? And again, anybody and everybody can do the deep dive there on Blossom.
Yeah, you definitely can go check it all out on Blossom. I share it there for everybody to see. You'll see all the trades I'm doing and stuff like that. But like I said, primarily I'm diversified in ETFs. That's the basis of my foundational investing strategy right now. So, and those are broken up into percentages for North America and around the world. It sort of trickles down because, let's face it, the States and that market is very strong. And so it's a larger part of the portfolio. But as I mentioned earlier, I do have some single stocks that I still hold from when I first started. And as I said, through the gamification process and learning, I'm trying to decide, well, what should I do with them? For instance, I just sold a single stock position off that I'll talk about in my month-end video when I do it, which is coming up right away, and the decisions and why I did that. Now, I have introduced some income, and you can check out all the videos that I've done, but the basis for it was, why would I do this? Well, first of all, I wanted to experiment. Like anybody, I wanted to see, like, what does this mean? So it's interesting you mentioned the dividend part. If you go back, because the nice thing about Blossom is when you connect your account, you can see the trend of your dividends or distributions, because they're two different things. And you'll see that they've steadily grown over time. And then all of a sudden they take a spike. That's because I started experimenting with these income funds. But the truth is, like you said, Ari, if you look at that, you're going to be like, wow, that guy's making $25,000 a year. But what am I giving up? That's the real question. And that's one of the biggest questions on Blossom right now. Does the strategy work for certain people? Yes. What am I giving up if I do this strategy? Stuff like that. So I'll be honest, that $25,000 income that I see right now, a lot of it's from those income funds. If I was to dial that back to the point it took off, I think I was sitting about $12,000, about $1,000 a month from just sort of the regular ETFs that I hold. And for context as well for everybody, I do hold some REITs. I wanted some real estate exposure. I initially started off with some single positions, but then I found that there are a couple of ETFs that allow me to have exposure to all of them. Because one of the things that I found challenging when I first started investing is, how do you find all the right information to make the decision to invest in one singular position? And given that I'm a dad and I have a full-time job and all that stuff, with I'm busy, I don't have the time that I would love to. Plus, let's face it, I invest a lot of time into this. All the content creation that I do consumes a lot of my time. But I also realize that this ETF strategy gives me the broader exposure, and then I don't have to worry about that. And then in the meantime, if something comes up in my learning, I'll be like, oh, maybe I'll look at this one position and see if it's worth investing in. But to be honest with you, the time and effort that you need to go into to learn whether you should invest in that, it's a lot.
I can't say it enough. What you just shared, I think, is arguably the most powerful thing I've at least taken away from this. Is everyone's looking at what they're gaining, but no one's actually taking a look at what they're missing out on in terms of if you chose a different strategy? And again, the income can be sometimes so freaking enticing. And you see someone's portfolio, $25,000 a year, $50,000 a year, but how is it being taxed? How, what are they missing out on? Again, to your point, so that's something that just everybody should think about, especially the younger investors who can afford to take on more risk.
Yeah, that's actually a good point, Ari, and you're making me think about one other thing. So one thing I did is, I didn't talk about it earlier, foundationally, if you don't have an emergency fund, make sure you have one, because we had an emergency and we had to use it. But the way that you manage that emergency fund is also important. So originally I had that money just sort of sitting around, cash, liquid. That's the ideal circumstance, ready to rock and roll. If I need it tomorrow, I get laid off. In our case, the furnace went, the air conditioner had to replace all that, needed that money right away. But then I was like, well, wait a minute. This money sits around in, say, an account earning 2 to 3%, depending on, where you hold it. Is there another way to do it? Oh, wait a minute. Yeah, let's try this income thing. So if you're interested to see how that's doing, I'm doing a series with my emergency fund where part of it, 50% is in VFV, which is the S&P 500. And then the other portion of it is in a bunch of income funds. And I'm watching and I'll be tracking to see when you mentioned the dividends or the distributions, does the ETF VFV, is the growth outpacing that total return? Now, that's another term that reminds me. Total return is important, but you have to look at both parts of it. So this is sort of an interesting experiment, I guess. Now, I'm not suggesting anybody should do what I'm currently doing at all. However, and the downside to it is if the market takes a downturn, which I think in the near future, if you look statistically or historically, we're coming to a downturn. What that looks like, they're measurable. We don't know. But if it does downturn, it could have a very profound effect on that money, because then I would have to sell those positions to gain access to that cash. So at any rate, the point being, you have to look at stock appreciation price, no matter what it is, ETFs, single stocks, income funds, doesn't matter. That is equally important. So that's that total return, I guess.
Few key words there for everybody that you mentioned. Total return, I think, being the most important, because again, we'll look at usually one or two metrics and we totally fail to look at total return out of the excitement for others. But two terms that I also think are equally as important are dividends and distributions. And I don't think a lot of people read a prospectus anymore, if they ever did. But sometimes we just think the distributions are, in fact, the dividends. Can you break down those terms and what you've learned from them?
Yeah, so a dividend, and I like the Warren Buffett analogy, but if Warren Buffett invests in a large company, I'll use like Exxon, for instance, that company will earn, or it'll generate income through its business. And when it generates income on their balance sheet, they got to do something with that money. So that money then could either be reinvested back in the company, or they can pay a dividend. Okay, so the dividend would be, hey, Ari, you own one share of Exxon, and this week we're going to pay you 10 cents on that share. Here you go. So that's a dividend. A distribution is created by a fund as it generates income. And you can help me out a little bit here, but an income fund would write a covered call or a put, and from that gives the person an option to buy a contract. But to do so, they then have to pay for that contract. I hope I'm simplifying this. That money that's generated from that contract or the purchase of that is a distribution, and that's the difference. Now, I must admit, I'm not totally clear on the taxation part, and it might be different in Canada and the States, but needless to say, that's the difference between the two. You're not looking at a company that's growing. You're looking at a fund that's generating some income to give you a distribution. They're slightly different.
You hit the nail right on the head. And I think also another interesting concept is return on capital. A lot of these companies are doing that as well. But most, again, like I shared before, most people aren't even reading a prospectus. And I feel like because of the buzz and the excitement of all of these new products, which by the way, only really recently, ETFs have now officially surpassed the amount of individual stocks that are out there. So I think because of all this buzz and excitement, we're just totally failing to understand our investments. And there's so many out there. So Darren, how would you recommend investors go about, one, finding stocks to invest into, stocks or funds, and two, understanding which ones are appropriate for their portfolios?
Yeah, that's a great question. So the first thing I would say is this, and if anybody ever asks me advice, which obviously you just did, but I don't give advice, but I'll give you some suggestions. So for example, there are lots, it's like a car dealership. That's the best way I can describe it. So there are lots of different fund companies, and they have a variety of products, we'll say. That'd be like cars. And so I'll use the S&P 500 because it's the standard thing that most people might understand. So the S&P 500 being the top 500 companies in the United States. Now, that's an index of companies. And other companies, so Standard & Poor's is the one that actually developed that. And then other companies have now mimicked that, would be the best way I would put it. But there are more than one product in that space, we'll call it. So the S&P 500. So in Canada, for those that are from Canada, you could look at like Bank of Montreal has a line that has a product or an ETF that mimics the S&P 500. Well, so do other companies like BlackRock, and Vanguard, just to pick a few. So I think it's important to go, okay, if someone says you should invest in the S&P 500, why would you pick one fund over the other? And that's where the prospectus is really important, because you'll find out a lot of information in there about what the distributions are or the dividends, depending on what type it is, how much it's costing you, because for every fund, there is a cost to hold it. And you want to reduce costs. So that's where a little bit of that research is important. So what I'm saying is to determine what you should put in your portfolio. If you saw, like, you're going to go to Blossom, your feed's going to blow up. You're going to see, because I'm a beginner and I need help. And someone's going to say NVIDIA, and they're going to say whatever. If you choose to put your money in that, I'm going to tell you right away. Now go find out how many NVIDIA stocks are there. Well, we know that there are only one single stock. But if it's an ETF, go find out what the other ones are, or what are the competitor versions of it, and figure out if that works for you.
Yeah, and speaking of which, I mean, these days you can get like 2x NVIDIA, 3x inverse NVIDIA. Like because of ETFs, there's so many more options that are out there, which I think, again, it could be very confusing for an investor, especially a new investor who's looking at this saying, well, if NVIDIA is single stock, but what about this 2x? What about those products, Darren, would you say? Are those green lights for you, or those red lights? Do you stray away from those?
You just struck another thought with me, because I do say this in my posts and in my videos when I talk about what I would have done had I have known what I know now. So the best piece of advice that I can give people is, because it's going to be so overwhelming, there are a number of all-in-one funds. And it's a great way to dip your toes in the water, if you will. Is it the best strategy? I don't know. That's up to you to decide. But what it does allow you to do is get your money in the market. Like we said, it's in there. It's working for you. And then you can figure out the rest. So I kind of forgot to mention that in the sort of the foundational question that you asked me. I think that's a great way to get yourself going. And there are lots of them. So do the same thing. And I could name a bunch of them, but each fund company has different versions of it. And they have different strategies baked into them, which would then allow you to learn more while you figure out, do I want to invest in all these other NVIDIA products? Because it'll allow you to understand what that product does. A good example of, I think what you're asking me is like Tesla. You can own the underlying of Tesla. You can own an ETF that has exposure to Tesla, or you can own some of these income products that give you exposure to Tesla. Each one performs differently. Each one is going to be different for each investor. So if you want to look at these, I think the terminology is, the more risk you take, the more opportunity cost there is down the road for you to see returns. But with risk comes the up and the downside. And that's an important part. When you talked about what people see the income, they're like, yes. You also have to recognize that there is a downside to that. And so there's a safety mechanism built into, maybe that's not the right term. Carr might disagree with my safety term, but needs to say some funds give you a little bit more safety when it comes to that up and down swing versus other products. So that's where you learn about your risk tolerance too. So for those single positions, we should put a roller coaster overlay on this, because that's how I would describe it, as some guy in the roller coaster going, ah! When you're riding some of these single stocks, and you might not even know that it's happening because you didn't learn enough about it. So that would probably be my only piece of advice when it comes to that. And let's face it, I use Tesla as an example because it's such a volatile stock. And I know that people will see it and be like, oh, I plow money into it and look at that huge rise. Well, you need to back out of that chart and check out when it also went down, because it seems to go up and down equal amounts.
Yeah, and then to circle back, it's like, well, how well can you sit on that roller coaster on that downswing is more important. Everybody's a great investor when times are good. But, like you said, if we have that downturn and soon, which I would foresee, I mean, we can't go up forever. So who's ready to go down? And are you ready to sit on those funds too, or what are you going to be doing with them?
Yeah, and that's important too. Like when you mentioned about my age currently and some of the people that are watching. So if you're younger, that gives you that opportunity to ride out that. But you also have to have the psychological mindset, like as you're riding the roller coaster down, like, okay, this will have a bottom. And I would recommend that and you can use the S&P 500 if you want, because it's kind of there's sort of standard measures that I've learned into the market, and the S&P 500 is one of them. There are others, but if you zoom out to look at the history, you'll see close in, you'll see this big dip. But if you zoom out, it almost looks like a straight line. That's a key concept to understand. Now, me at my age, if let's say I was going to retire in 2 years, then I might want to focus my strategy slightly differently so that I can still maintain that cash. Because if you hold stocks, we'll call them, and they swing down and you need to take the money out, you're selling them and when I say a loss, I'm going to quantify this or qualify it a bit. If I invest early and it goes up and I sell it on a dip, yes, I've lost the dip, but I didn't lose the growth between then and there, if that makes any sense. So those concepts are important to understand. Where's your time horizon? When do you need that money? And how would you manage it? Younger is better. We can ride that out on that roller coaster.
Well, here's a question I have for you, just in regards to a term you used or threw out there before, the safety mechanism. I want to run with that for a second, because a lot of investors would argue that a safety mechanism is diversification, and then there's some other investors who say diversification. And so my question is, how many holdings should you have in your portfolio? How much is too much? Is there such thing as, one position too risky?
Yeah. Hey, sorry, I don't mean to interrupt, Ari, but your I don't know if your Wi-Fi is bad, but you're all grainy right now.
Which, thanks to Riverside, it should be fine on my end.
Okay.
Yeah.
You can ask again and I'll answer. Just ask it again.
So let me just see how I start. So in terms of, how did I start that? So in terms of the term that you threw, now I gotta go back. The term you threw out was that safety mechanism rather. I want to know, is there one position that might be too risky to hold in there? Some people like to run with the term diversification, while others go with diversification. Where exactly do you fall?
Yeah, so again, that's another great question. So, and that's why I said I know that Carr would give me a hard time about the safety, because let's face it, when it comes to finances, there is no true safety. The truth is, and you take his approach, the all-in-one, him and Mo and others, that all-in-one approach gives you that diversification. So, and you're right, that diversification, if we were to use that as an example, so if I'm invested in a fund that has like XEQT, I'll use an example, and some of the viewers may not know what that is, but you can go look at it. But essentially, it gives you international exposure. We'll just leave it at that. So let's say the U.S. market is not doing very well, but emerging markets are. That's where that safety comes in. So while one part of the portfolio is up, the other one's down, they kind of balance each other out. Now, on the other hand, if you tilt it, that's something else that some people talk about. We're going to tilt our portfolio a certain way. In many cases, for I think newer investors or beginners, they tilt it to the U.S. because it's the biggest market. So let's say you tilt your portfolio over 50% into the States, and we go into a downturn. Your entire portfolio has a bigger, down sweep. So that's where people refer to, ooh, that wasn't you don't have safety built in there. As far as like safety goes, though, like there isn't any safety. No stock is safe. No ETF is truly safe. We don't know what the markets are going to do. History tells us that, there's 10, 20, and even 30% drawdowns. I think the worst one was close to 50%, if I'm not mistaken. You don't know when that's coming. There's no way to protect yourself against that other than to have the mindset built into your risk tolerance to know, all I know is I need to prepare better for when that stuff's going to happen. So, yeah, there really isn't real safety. Now, diversification, it's funny, I was actually thinking about that last night, because some people would say that if you have too many funds that overlap, that you're diversified, or that you're, I don't know, maybe you hold a whole bunch of income funds, will say that you're not, now you're diversified, or maybe those income funds are concentrated in one sector, because that's also important. Is you want to spread your example might be utilities and consumer goods, because those all-in-one funds or ETFs, they kind of balance that out as well. When you're looking at the prospectus or what's in it, it'll tell you what area that's in, whether it's financials or so on and so forth. So if you tilt it towards, say, I don't know, actually gold, that's a good one right now. Gold seems to be the talk of the town because gold's doing really well. Again, I'd say I'm a beginner now, but if you wanted to hold gold, you should have bought it a year ago. Don't go with the hype now. Now, with that said too, like with the gold piece, it doesn't mean you can't get into it, but don't expect it to go up, because it's probably going to go the opposite direction in that regard. I kind of went off on a tangent there, sorry.
No, I actually like that you brought that up, and it begs a good question for any beginner or novice, even experienced investors. The trends that are out there, when to catch them, when to play them. As you shared, like gold would have been a phenomenal investment if you made it a couple of years ago, but now It's been on the upswing. So how much higher can it go before it comes down? When do you get in on trends?
So it's a good question, because I think, so when I use the analogy of looking at the charts, today it's probably getting up to some sort of peak. We don't know when. And it will definitely take a downturn. Take that chart, zoom out on all those stock positions. It'll show you. There's nothing wrong with getting into it today. You just need to know that when you buy into it today, that it will go through a downswing. Your price will drop down. But if you keep dollar cost averaging into that will average your price out over time, and eventually it will swing back up. It's like any big downturn in the markets. And some of the videos I've done, I put sort of charts on to show you all the COVID-19, all these terrible downswings and stuff like that. So I don't think there is a perfect time. I was going to say I don't believe in timing the market, and I guess I don't, because how do you do that? There's no amount of data that's going to tell you this is the time, because there's people that do swing trading, which I really don't know a lot about, but basically we're buying at one point of the day and selling at another, I think is kind of how it works. So I don't think there is a perfect time. I would say that you did miss it. If you're trying to invest in gold now, you missed it. So if you invest in it today, look at the charts, zoom out. How long ago did it look like a big upswing, and what happened? Because then you could look down the road and say, okay, it's going to take 5 years for that trend to work back out, and that's where you'll see you benefit from it, is down the road. I think that also goes to what we talked about, is delayed gratification. I really like that terminology. You have to know that whatever you're doing today, it may not work until 10 years down the road, 20 years down the road. Or even that leads me to one other thing, is like that $100,000 is like that big tipping point in that compounding part of your investing. Whatever you can do to get to that point is important. And that's a key concept as well. But you also have to realize that you can't go broke doing it. And you can't be sad because I can't go on trips and all that. Don't do that either. Find a balance. You're never going to be Warren Buffett. I mean, that's not to say that someone couldn't be, but take it slow, take it steady, and you'll eventually get there. So with the goal question, or any position, just know when you go in now, you're going to see ups and downs, and eventually it will work itself out over time.
I can imagine someone sitting out there right now just cringing at the fact that you just said they'll never be Warren Buffett and their pencil just broke. But that's the reality. I think we're all trying to beat other investors, even on Blossom, right? It's a friendly competition for the most part, but I think when you get to the point of what you shared, not having balance, it gets pretty dangerous. And there's the FIRE community that's out there. Now, a lot of these guys or gals in the FIRE community will hit their numbers early on at a great sacrifice, I might say, to their life. So at your age and kind of having lived, through your 20s and 30s and 40s, what would you say to the FIRE community folks?
Yeah, that's actually an interesting one. So I kind of wonder what I would be like if I was their age, younger, looking to this idea, if I had the knowledge that they do. But the one thing that resonates with me a lot, if you do a little deep dive, I guess you might say, into the idea of FIRE, is, so I'm 52. I'm likely to retire in about 8 years. I'll be 60. But I can retire in 2 years because at 25 years I could retire. And then I was like, what am I going to do? Oh, wait, I like being a content creator. So I have something in my back pocket that will allow me to be engaged. Now, money does not buy happiness. So if you think that having a ton of money and getting to that sort of FIRE idea is going to make you happy, I don't think that's true. Think about, no matter how old you are, think about money. Has money ever made you actually happy? What money does is it gives me the option to do a lot of different things. I could turn my camera around and show you some of the things that I bought with my YouTube income. That's what gives me passion. So for the FIRE folks, I hope great. If you can become Warren Buffett, and you can put your mind to something, you can do anything. That's what I teach my kids. Do the best you can. You could become Warren Buffett. But if you're going to be in the FIRE community, what are you going to do with your time? Maybe you're going to be a parent. Maybe you're going to have kids, and that's your early retirement. You're going to spend time raising your kids and going to sports and doing those things. Just have a plan. I think that's really important. All too often we hear the story of, I retired and so passed away 1 year after they retired. Why? They're bored. They don't have anything to do. They're not engaged. That's again, there's a lot of psychological stuff built into this. So I think that ultimately, now I can't put myself in their place. But yeah, I would hope they would have a plan.
I think a lot of investors talk about Warren Buffett and other greats that are out there in the industry. But what we often fail to do, and I talk about this a great deal, we often actually fail to see their motivations or ambitions behind why they did what they did or the career moves that they made. Like, when you read any of Warren Buffett's books, biographies, or really watch anything of Warren Buffett, he actually never talks about the pursuit of money. Right. He talks about the pursuit of loving numbers. And so perhaps this is more a conversation about how to find yourself. So let me ask you that, Darren. How would you recommend investors find themselves?
Oh, I mean, you have to have a passion. That's why you do this. That's why I wanted to talk to you, because you have such a passion for it. And other people that are in this space, I think you gotta have a passion. If you're looking, I would say that if you're just looking to throw your money in the market and make it grow, that's fine. I mean, we all have to do that. Some of us don't have pensions. That will be your pension. You have to prepare for retirement. If it's a job, yeah, but it should be a passion. And if you can make it a passion, boy, then it's fun. Like, I thrive to read articles and learn more. And I get that why some people wouldn't necessarily want to make that a focus for them. But at the very least, have a base knowledge so that you can understand what you're doing. And if not, you often hear the stories of I kicked my fund manager to the curb because he was charging me too much and not making me money. I would say that's FIRE, that you want to do more. But if you're content with paying someone to manage your money, which is totally fine, there's nothing wrong with that, then your money will grow for you, but you won't be as engaged in that sort of your finances, digging deep into them, figuring out how to make that money work for you. And something interesting about Warren Buffett, you hit on a couple. I want to highlight a couple points. Warren Buffett still lives in the same house, if I'm not mistaken.
Yes.
That speaks volumes. I've moved like I can't even count how many times I've moved in my life, both with work and when I was younger. My dad in the mining industry moved around a lot. That's crazy talk to me, but there's something there. Like our homes, for the most part. In fact, I just did this video for those in Canada, the Smith maneuver, about how to make your house debt grow for you. These are your home is one of the biggest debts you will have, or one of the biggest equities, I guess I should say, not necessarily debt. Most of us will have mortgages, but yeah. So when I learned about that idea, like what can we do with that debt? More passion. I was like, oh, cool. I can learn something else about money. And like you say, it's less about it's really less about the gains, because like you said, if we remove the income, which for those of you that don't know, I only have about 52,000 of the 430 grand I have in my portfolio in income funds. If you remove all that, the income is like from the dividends is really small. That's not the motivation for me. The motivation is to see how I can work with my money and make it grow for me. And something else I wanted to point out too, when I said people are not, money won't make you happy. We were listening to, I guess we'll call it a celebrity. I'll just say a celebrity going through some trials and tribulations, and they're like one of the richest celebrities that are out there. And I was like, oh, that's kind of cool, but like, what do they do with all that money? Oh, wait a minute. They need a security detail. They need people going online and getting rid of all the bad stuff online. So money can actually create problems. I don't have to deal with that. Like, yeah, I'm on here talking to you, and I have a very small space with, the subs that watch me and stuff like that, but I don't have to deal with that. And I enjoy what I'm doing. So I guess that's why I want to highlight, like, Warren Buffett loved what he does, and he made it a real passion, and look what he's done with it. It's like, even if you want to start a business, on your own, you have to be driven to do that. There's a lot behind the scenes there.
Yeah, I think there's so much that goes into, wealth and the mindset behind wealth, even humility behind wealth. Because to that point, it's like when you're celebrity status or you're walking around with, all this money, I mean, it really can get to your head, and you lose the best part about being a human, which is the experience of living and really enjoying instead of being in the rat race. Which, by the way, I always say, like, even if you think you're on this crazy rat race, at the end of the race, you're still a rat. Like you're never going to escape this thing.
Actually, that you have some really great points. I know you've done a lot of interviews, so I love that what you just said, because what makes me rich? What makes me rich is to come home. Like last night when I was working, I dropped by the house, and the kids were so excited to see me. There was no money involved in that. They just came up and gave me a hug. I was like, wow, this is great. Why are they like that? Because we've given them opportunities. I'm actually teaching them about this stuff now. I'm like, you are not going to make the same mistakes I did. You know what? Maybe I'm being unfair to myself too. I have a list of things that we got from a motivational podcast. If you keep showing up, good things will happen. That's one of them. And that's the truth. I could have given up at this whole YouTube thing a while ago, because it's hard. It's frustrating. Could have given up on finance. I didn't want to. But these things have made me a happier person. And I can see it now because my kids are happy to see me when I come home. Before I started doing this stuff, I think I was trying to find myself in some way. And obviously with my father passing, that's the catalyst to this. So a very sad event turned into something very positive.
I love that. There's nothing like a dose of optimism on any little sprinkling you can put it in life. Darren, I got one last question for you here. Your biggest piece of advice or suggestion that if you were to go with one last message for us all, what would it be?
Oh, that's a tough one. I think no matter how old you are, I use this actually, if you're sitting on the sidelines, it was actually in one of my posts, and you're kind of wondering, it doesn't really work in Blossom because most people in there are investing, but if you watch this podcast or, one other one, and you're like, I don't know if I could do that, I'm here to tell you that you can. And it doesn't matter how old you are, I see teenagers on Blossom. I'm like, wow, that's amazing. Like, I'm not sure why they're on there, but either way, you can do this. It's not that difficult. Just know there will be a lot of hurdles, a lot of learning, but in the end, you're going to learn some stuff. And I think when you have, that's the way I'd like to sum this up. When you have a good relationship with your finances, I won't even say money, with your finances. And the example I would give is, if you want to go out with your wife once a month, or your spouse, pardon me, to have a meal, and that costs $150, because most of us, that's a fair bit of money, and that makes you happy, that's okay. But don't do it 8 or 9 times in the month. I think that's the real big lessons that I've learned. Have a positive relationship with your finances, and really anybody can do it. So if you're on the sidelines, step off, start, and you get your money going, working for you.
Such a powerful hour. Investors, once again, Darren's all over Blossom, so you got to find him on Blossom, connect with him on Blossom. He's got a YouTube channel as well. All the links will be down there in the pinned comment and description. Darren, thank you so much for joining me on Masters of the Market. Such a powerful hour, insightful, everything in between. And to all the investors out there, until the next go-round of Masters of the Market, we will catch you all there.